Welcome to the Wealth is in the Details podcast. In this podcast, financial planner Peter Raskin helps families and business owners understand and prepare for their wealth journey. Along the way, thoughtful and detailed planning can provide clarity and confidence as clients confront a multitude of financial decisions. Listen in as Peter shares stories and insight into people's wealth journeys. Now, let's get into today's podcast.
Today's topic on The Wealth is in the Details is inflation. After years of near 0% increases, inflation in the past 2 years has hit levels we haven't seen in decades. I'm Patrice Sikora with your host, Peter Raskin. Now, Peter, inflation seems to be easing as interest rates rise. Overall unemployment is low. The economy continues to grow, but higher prices for food, goods, services, all taking a toll on our wallets. Could you put that all in perspective for us?
Yeah, I think it's such a timely topic for many. It's certainly much discussed, especially by the media. And it's an important topic for our country as well as, economies around the globe. Mm-hmm. And it affects everyone. Every economy is affected by inflation. It's a normal part of an economy that's productive and growing. I think we always need to keep that in mind. We actually want modest inflation. You probably have heard that the Federal Reserve has a target of 2% inflation. Right. But I think it's important to know that inflation affects different groups within our society at different times and in different ways. It's not all good and it isn't all bad either. It's also important to consider that it's all relative. Inflation seems high compared to what it was, over 2 years ago when it was almost zero, but it's relatively low compared to what it was in the 1970s.
And I remember those years because at the end of the 70s, the beginning of the 80s, I got my first mortgage, Peter, and the interest rate was almost 15%.
Exactly. Yeah. So this recent inflation has been a concern, and I don't want to discount it, but it's a real problem. Inflation's a real problem around the extremes. So, I'd consider an extreme in 2021 throughout 2022 when inflation just jumped up dramatically in such a short period. That's not good.
Yeah. So I'll tell you, why don't we start with what is inflation and how do we measure it?
Yeah, simply put, inflation is the sustained and broad rise in the prices of goods and services over a longer period of time. And as I mentioned earlier, a bit of inflation is normal. And when it happens slowly and modestly over a longer period of time, it doesn't seem like such a problem, does it? Especially if our incomes keep up with those price increases. And I think a good way to talk about this is just a cup of coffee. In 1970, a cup of coffee cost 25 cents. In 1980, it was 45 cents. 75 cents in 1990. $1 in 2000. And 22 years later, the cost is $1.85. And that would be a bargain in a lot of.
I was going to say, I don't know where you're buying your coffee, but okay.
Yeah. So now I think we accept this cost increase of coffee, and people seem okay paying for that little pleasure. So it's a normal part of our economy. It happens, and we need to accept it. Now, measuring inflation is also an important conversation, and it's an inexact science. Mm-hmm. But there is a federal agency called the Bureau of Labor Statistics, and they're charged with this task. The BLS collects about 80,000 prices every month from 23,000 retail and service establishments around the country. I think about all these people in a big room making lots and lots of calls. Checking on prices, but that's in effect what they're doing. And with this information, they calculate the Consumer Price Index, the CPI, which is a weighted average of prices for this basket of goods and services that attempt to represent total U.S. consumer spending. But we all spend differently at different times. So I think that we'll talk about that in a bit. But when we hear about that the CPI has increased, the consumer price index is increased, it typically means that this basket of goods and services has increased in cost compared to what it was 12 months ago. So just to keep that in perspective. Now, as I mentioned, this CPI basket of goods and services is weighted. There are 8 major categories or groups of expenses. There's housing, there's food, transportation, commodities, healthcare, energy, education, and then other goods and services.
Yes.
And so depending upon what you're spending money on will determine how inflation affects you. So like housing represents about 35% of the index. Healthcare is about 6%. Energy is 7%. Food is 13%. Education is about 5%. And then commodities are 21%. If you're, spending a lot on housing, if you're a renter and rent keeps on going up, your personal inflation rate may be higher or lower than the CPI.
I'm surprised at food too, only 13%, but the way prices have gone there, I should think that really, that's going to clobber a lot of people.
And it does. Absolutely.
I think a lot of listeners really want to know, what does this mean for me? And you've
Right.
got a list of 10 common effects of inflation. So let's go through that. So the first way, basically inflation erodes your purchasing power.
That's right. Inflation means that your dollar today are going to buy fewer goods in the future. That 25 cents in 1970 may purchase a tablespoon or 2 of coffee today.
You're really on that coffee kick, aren't you?
Yeah, right. Exactly. But my first apartment in 1983 cost me about $250 a month.
Yeah.
And today, that same apartment is probably going to cost like $2,500. So you can see how that can really affect people differently. We all experience inflation on a regular basis, and it's usually manageable as long as our income continues to keep up. But if that doesn't happen, inflation feels like a slow tire leak. Eventually it affects our standard of living. And that's why it's vital that people prepare for this long-term bout with inflation that we all have to live with. And it drives your investment decisions. In general, no risk savings and investment accounts like bank accounts and U.S. treasuries, short-term treasuries, CDs, they don't keep up with inflation. Bonds do a better job keeping up, but just barely. And then the asset class called stocks, ownership in companies, a diversified portfolio has a really good chance over a long period of time of actually beating inflation. There'll be periods of time when it doesn't, but over a longer extended time period, stocks are really more inflation proof than other kinds of asset classes.
But as you say, it's over the long term. You're not going to see 1 year, 2 years. You've got
exactly.
Yeah. Which makes it interesting in the fact that we had those 2 years of really surprisingly strong inflation. And was it 21 and 22, 8% 1 year? That was pretty outrageous.
It was, and it went up very, very quickly.
All right. Now, inflation, you mentioned this earlier. Inflation disproportionately impacts lower income consumers. Tell me about that.
It's really true. So lower income consumers spend a higher proportion of their income on necessities than those with higher incomes. Right. I think we all kind of know that. They have less of a cushion against this loss of purchasing power. I was in conversation recently with an employee, a young employee at a daycare center. We do a lot of retirement plans for small businesses. And I was talking to her about her retirement plan. And, she's young, doesn't make a lot of money. And she was so upset that she just can't contribute to her 401k plan right now because everything's gotten so expensive. Her rent, her car, her groceries, her student loans are kicking back in.
Right.
And these necessities, she doesn't have a choice about this stuff. She needs a place to live. She needs a car to get to work. These are necessities. And those necessities represent, over 100% of her actual income. And we were talking, she knows she should do it. She knows she should contribute, but she's just not feeling comfortable right now. And I compare her situation, to most of our actual clients that we work with, who are, the vast majority of them are affluent. They've got lots of options. They've got excess cash flow. Some are wealthier than others. That's fine, but they're all okay. And while they aren't happy that they're spending an extra $50 or $100 at the market each month, or that it costs more to purchase a car or to go on vacation, all of those things, they're actually managing just fine. And I think it's something that we need to be empathetic about. We need to think about those people that are kind of living hand to mouth, which is a lot of America today.
More and more from what we're seeing or hearing.
Yeah, exactly.
All right, there's inflation, there is deflation. Inflation keeps deflation at bay, you say. If inflation is bad, quote unquote bad, is deflation, quote unquote, good?
Right. Good question. So I think it's just important to define what deflation is. Deflation occurs when the prices of goods and services actually decline. And I'm talking about the general economy. I'm not talking about a specific item on sale.
Right.
I'm talking about the general goods and services. And if that happens consistently, that means our economy is contracting, getting smaller, which is not a good thing. Matter of fact, it leads to things like high unemployment, less consumer and business spending, and then eventually loan defaults. Right. And that can lead to banking crises, and just like compounds. So we really want an economy that's growing steadily with modest inflation. That's kind of that Goldilocks economic environment, not too hot, not too cold. But both consumers and businesses can kind of plan ahead. They can thrive. That's what we want. So deflation is actually not good. And in general, when we're coming off of high periods of inflation, it doesn't mean that all of a sudden prices are going to come back to where they were a year or two ago. They may stay high. They may stay at that higher level, and they may not all come down. Some might. Energy and food, those things tend to be more volatile, but other prices may not come down, like housing costs. Right. They may stay high.
In all honesty, Peter, when you see a price go up, don't count on it coming down.
Don't count. Exactly. And that's I think, that's part of the deal. And that's maybe why a lot of people are not feeling good right now, is because they keep on hearing, oh, inflation's getting under control. But they're still paying way more than they paid on their rent a couple of years ago. They're paying much more for groceries than they were a couple of years ago. Again, vacations are more expensive, cars are more expensive, everything's more expensive, and they're feeling it. And they're saying, hey, this doesn't feel good.
All right, the next point. Inflation feeds on itself when it's high.
Yeah. I think it's also just important to offer some humility here. We really don't know exactly why we experience bouts of high inflation. There's always lots of theories, and there's people that say they sound so convincing that they know why inflation is going up, or when it will go up, or when it will come down. There's just, but in general, we don't really know. And I suspect it's just a mix of a lot of circumstances. And, because if we knew what caused inflation, we could avoid it, but that isn't happening. But what we've seen is that there's an exacerbation of inflation when the consumer feels that inflation's out of control. And inflation can get worse because of that. So if my dollar is worth less tomorrow, I'm more likely to spend today because I get more bang for my buck.
So a self-fulfilling prophecy.
It's a self-fulfilling prophecy, right? We saw this compounding and consumer anxiety. We've seen it in the past. The best known example is that hyperinflation in Germany after World War I. People lost faith in the German mark because it became less valuable day after day. Now, that was a very exaggerated example, but we experienced hyperinflation in the 1970s. You and I talked about that before, when inflation was above 13% and unemployment was also higher than 10%. Those were serious times and not good for our economy, and a lot of people suffered. So yeah, inflation can feed on itself. There's a psychological piece to inflation, never mind the all the economic issues that may cause inflation.
Hi, this is Catherine Broy from the Raskin Planning Group. Apologies for the interruption. Thanks so much for listening to Wealth is in the Details. We hope you're enjoying it so far. If you have any questions or would like to talk more about this topic, please visit our website at www.raskinplanning.com. Look for the podcast's show notes and connect with us via social media.
You kind of were skirting the issue of the Fed, the Federal Reserve. So the next point is inflation and interest rates. What is the connection there?
Yeah, so in order to avoid this hyperinflation, which really can devastate an economy, governments, especially from the economies of the established world, the established economies, over the last century, they've tried their hardest to control inflation, and they use what we call monetary policy to do this. And in the U.S., we call the Federal Reserve has an open market committee which controls short-term interest rates, and these interest rates are the rates that banks charge each other to borrow funds. Mm-hmm. And by increasing these rates, the Fed is trying to make interest rates go up for businesses and consumers. And what does that do? Well, that slows down the economy because it becomes more expensive to borrow funds. And it dampens economic demand and really wage growth. So that's the goal, is to slow down these price increases and thus slow down inflation. So while the Fed can only control these short-term interest rates, longer-term interest rates are often affected as well. That's good news and bad news for people. If you're a borrower, if you're borrowing money, it's going to cost you more to borrow money. So if you need a mortgage, it's going to cost you more to buy a home. If you need to buy a car, it may cost you more to buy that car because you're paying higher interest on a loan. But if you're a lender or you're a saver, if you invest in CDs or bonds, you're going to receive higher income. So in effect, inflation, once again, can help some and hurt others.
Yeah, in fact, CD rates were nothing, absolutely nothing just a couple of years ago. And now suddenly they're 5.25%, you're finding.
Exactly. And a lot of people are chomping at the bit for that. They think it's great.
All right. Economic growth and employment in the short term. How does inflation impact that?
What happens during periods of modest inflation, it's likely the economy is growing, again, at least modestly. But when the economy grows, more people are gainfully employed, which means more people are spending and traveling and saving and investing. And business in general are expanding. But we know this is cyclical. The economy is always expanding, but sometimes at a greater, with more velocity than other times. So there are business and economic cycles where there's less growth and higher unemployment, and other cycles where there's more growth and higher employment. And I want our clients and listeners to really expect these cycles. It's going to happen. It's just natural. What we don't want is a real slowdown, but we often can get that too. Like the Great Recession can be devastating to a whole generation of workers. We want to avoid those real cycles, those bad cycles in the economy.
Those extreme cycles, maybe we should call them.
Yeah, exactly.
Peter, what about inflation and recessions? As you just mentioned, the Great Recession. Where does it play a role there?
So, inflation can really wreak havoc on an economy if it's out of control. And that's why we saw the Fed increase interest rates so dramatically in 2022. It went from basically zero, the interest rate, the Fed, over 5% in a very, very short time. And, some people feel that that they should have started raising rates sooner than they did, but they didn't. And the goal is to slow down the economy to the point where inflation subsided to a level that the Fed believes is sustainable. And as I mentioned earlier, that goal is 2%. Right now, we're a little over 3%, at least year over year. Remember I said that earlier?
Yes.
They're looking back over the last 12 months. So year over year, it's 3%, a little over 3% now. But the big fear for many is that that these rate increases are going to slow down the economy so much so that unemployment rises significantly. And then we might enter into a real recession, maybe a deep recession, but some sort of recession. And that means the economy is contracting. Mm-hmm. And that's not good. So the Fed is trying to this balancing act. They don't want inflation to go so high, which can increase unemployment and cause, real economic hardship. But they realize that they have to slow down the economy. So there may be some unemployment. It's this balancing act. It's kind of the lesser of the evils is what they're trying to do. Right now it appears that the Fed may have achieved their goal. We don't really know how it's going to play out. Inflation's dropped from a high down to, almost that 3% level. So that's good. Employment is still high and the economy appears to be still growing, but we still have a long way to go. This could happen in the end of this year, beginning of next year. We don't know how it's going to play out. But I think it's just important to understand why the Fed took such an aggressive role raising interest rates, trying to slow down the economy. And it's this understanding this balancing act between slowing down and maintaining growth.
And there were so many people, you were correct, who said, oh, this isn't going to work. They can't do it. It's way out of control. This soft landing is not going to happen. Some of those critics are now on the side of the Fed saying, hey, this they might do it.
They might do it, right? Yep. People that are predicting the future are more often wrong than right.
Okay. And that has nothing to do with inflation.
No.
Inflation and debt service costs. Talk to me about that.
Yeah. Again, just another example how inflation can help some people. So, if you I think the best way to describe this is an example. Let's say you took out a 30-year fixed mortgage when interest rates were hovering around 3%. Mortgage interest rates were at 3% in January of 2021.
Right. That's right.
The good old days. But now with interest rates much, much higher, mortgage interest rates and inflation higher, you're actually paying back debt with inflated money. So, if your wages keep up with inflation and or your investments are earning more than the interest cost on your mortgage, you're potentially ahead.
And isn't that a nice thought?
Yeah, isn't that a nice thought? Now, that's not why we don't want inflation, but if the timing can work, and you take out some debt at very low rates, maybe you want to keep it right now. Maybe you don't want to pay it off.
Yeah, okay. And seeing as a house really is a type of investment, what about inflation and other investments like bonds and growth stocks?
Again, I'm going to come back to this themes. Inflation can help and hurt. In this example, I think it's important to understand how inflation can hurt different kinds of assets like stocks, bonds, and real estate. And in this situation, inflation can affect interest rates. Remember, we talked about that earlier. Inflation goes up, bond interest rates tend to increase. And these interest rate increases or decreases can affect the value of your bonds if you try and sell your bonds before they mature. So just a quick, understanding bonds, you buy a bond, you're lending money to an institution or to a government, and you're saying, if you give me a certain interest rate for the next 5 years or 10 years, I'll lend you the money. And then at the end of that period of time, you give me my money back. Mm-hmm. That's what a bond is. You're lending money. So if you keep your bonds until they mature, you'll receive your promised value. But if you try and sell your bond before it matures, someone might offer you more or less than what you purchased it for. So if you buy a bond and you get a certain interest rate, a lower interest rate, and then interest rates increase after you purchase the bond, and you try to sell your bond, the only way to sell your bond to someone else is to offer that bond at a lower price.
Right.
So someone else can get an interest rate similar to what they could get elsewhere. So it's kind of math. So bond values go up and down depending upon what interest rates do. Inflation affects interest rates. So if interest rates go up, bond values go down. But if you hold those bonds to maturity, no problem. You don't lose anything. Another asset class that's hurt more often than not in inflationary periods are growth stocks. So certain kinds of stocks are negatively affected, and growth companies that are built to grow, like technology companies. So they may borrow money to grow their business, but if interest rates are going up, they might experience certain financial challenges, and it costs more to borrow.
Mm-hmm.
And so that can hurt them. Also, if you're a growth stock buyer, the reason why you're paying extra for that stock is because you're looking at their future earnings. They may not be that profitable today, but you're hoping that in the future they're going to be more profitable. But if we have high inflation, we have to discount those earnings, those future earnings, at a higher rate. And therefore, that means that the value of that stock is actually worth less today because interest rates are higher. So again, it's more math. Basically, there are discounts based upon current interest rates. And when interest rates are higher, growth stocks tend to be worth less because of this discounting that goes on.
Okay. Well, then how about things like real estate, energy, and value stocks? What does inflation do there?
Real estate is a great asset because it often keeps up with inflation.
Yeah, sure.
And the same with the energy assets, like oil. These kind of assets keep up. Primarily, if you think about it this way, that both real estate and inflation tend to be in limited supply. And so when there's a limited supply of assets and demand is increasing, the economy's growing, well, prices increase. And that's what happens typically with real estate and energy related assets. Value stocks usually pay current dividends. So there are companies that pay current dividends, and we call them value stocks oftentimes. And investors are paying, they're buying that stock for the dividend today, for the earnings that the company is actually making today, the money they're earning today. So those current earnings are more valuable than the future earnings in an inflationary period. Right. So oftentimes value stocks tend to go up when in inflationary periods, and growth stocks tend to go down. It's cyclical. We're going to have periods of time when interest rates are going down, and therefore growth stocks tend to go up. It doesn't always play out exactly that way, but that's often what we see. And we saw it recently in this inflationary period. Growth stocks went down, value stocks went up. Now that inflation is more under control, at least it appears that way, value stocks have gone down and growth stocks have gone back up.
All right. Well, Peter, that is quite a list that we just went through. And basically, as you said, it's all relative. Inflation is not all good or all bad. Moderation is the key here, just like life, right?
Exactly.
So, it sounds like modest inflation really is best for most of us in the economy, but we really all need to prepare for it.
Yeah, and I think that's exactly my point today. When we talk about inflation, I'm out of the prediction game. I'm not going to tell you what interest rates or inflation will be tomorrow because I really don't know. Inflation's a reality, and we hope it's moderate, but we need to prepare for the times when inflation's higher. Just like you prepare for stock market volatility by adding safer assets like cash and bonds to your stock portfolio. We have to assume that inflation's going to erode our purchasing power. Just think about it as it's a given. And that's why we think planning is so important. You need to prepare for this long-term journey so that you can be prepared for those times that are more challenging, like recessions, like inflationary periods of time. It's going to happen. It's going to be there. We're not predicting when it's going to happen, but you just need to be prepared, and your whole plan needs to be centered around your goals and objectives. Understand that there might be hiccups, things that get you out of sync. Again, just prepare for it. And that's what we do in conversations with clients.
Peter, thanks so much. How can someone reach you if they want to have this conversation with you?
Yeah, please visit our website at raskinplanning.com. They'll find our contact information there.
All right. For more insights from Peter, follow or subscribe to this podcast, The Wealth is in the Details. And of course, feel free to share this podcast with friends and colleagues as well. Thanks for being with us.
Thank you for listening to the Wealth is in the Details podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Lincoln Financial Advisors Corp. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Peter Raskin is a registered representative of Lincoln Financial Advisors. Securities offered through Lincoln Financial Advisors Corp., a broker-dealer, member SIPC. Investment advisory services offered through SageMark Consulting, a division of Lincoln Financial Advisors, a registered investment advisor. Insurance offered through Lincoln Affiliates and other fine companies. Raskin Planning Group is a marketing name for registered representatives of Lincoln Financial Advisors. Lincoln Financial Advisors Corporation and its representatives do not provide legal or tax advice. You may want to consult a legal or tax advisor regarding any legal or tax information as it relates to your personal circumstances.